Hey, I'm Rob Tatro. Today we're looking at 6 things you need to know about the CPP, Canada's pension plan, right here, right now. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. Today's a fun one. It's a doozy. We're talking about the CPP, the Canadian pension plan. How does it work? 6 things you need to know. We're going to get right into that right away. But before we do, take a sec to subscribe, like, share, and follow. All right. And if you have questions, you'd like to put them in the comments below. We'd love to hear from you. If you'd like to book a no obligation consultation to chat with me, please go to www.speaktorob.com. We can chat about this, your investments, or anything else that's on your mind with respect to finances. All right. First question we're looking at today is, will it be there? Is the CPP funded? Yes. So you don't have to worry about it. The CPP is very well funded. There's at least 75 years of proven future funding in the CPP. In the last 20 or 30 or so years, they've got really, really good returns. Remember, the CPP is an investment portfolio that we all put money into every single year. It's a retirement fund for Canadians. It is there to replace as a pension a portion of the income that you are set to earn in retirement. Now it's set to retire to put about a quarter of the yearly maximal pensionable earnings, 1/4 of that. But in the future, that number should go a little higher to about 1/3. So it's set to replace income that we've earned during our lives. And now that you're retired, you're going to dip into that. And it is well funded. The most recent actuarial evaluation showed that it is extremely well funded. They've got really strong earnings. The portfolio of the CPP is now managed by a team of portfolio managers. They have private equity, they have private debt, they have real estate, they have alternative asset classes, they have stocks, they have bonds. It's an incredibly well-diversified portfolio that's done well. So it's not just bonds earning 2% in there. They do have some really good investments in there that have done well, and therefore we are benefiting as Canadians. So will it be there when you need it? Yes. Second question, how much will I get? All right, so here's the thing. It depends. That's the long answer. So basically the way it works is Service Canada, which administers the CPP, looks at your entire working life from age 18 until your pension. It takes out up to about 7.5 of your worst years. And you can also apply to take away other years if you are either disabled or you're raising young kids. Then it bases your CPP benefit on the average of your lifetime earnings. So to get the biggest benefit, you do need the maximal pensionable income every single year. And that number goes up every single year. It's in the high 50,000s now, but it will increase every single year. So if you're at that number, then you're getting effectively 100% for that year. Now, most of us don't make that much money when we come out as 18-year-old adults. So therefore, there's likely to be a little bit less. And you don't get to offset. You don't get to use a year where you made $200,000 and take that extra and put it to years where you made less, unfortunately. So in years where you're making more, you're just not contributing more and you're not going to get more. So the maximum amount that you can get in 2021 is just over $1,200 per month. And that's going to increase every single year. And that's a CPP at age 65. Now, to receive that, obviously, you've had to contribute the maximum amount in at least 39 of those years since turning 18. So we talked about that. It's going to be difficult, and especially if you were out of the workforce for a bit. So age 65 is traditionally considered the normal retirement age for government benefits, and that's when you're getting 100% of your CPP entitlement. Now, you can call and figure out how much you're entitled to get. You can go to My Service Canada account. You could log in online, or you can even call Service Canada and try to get that information. I'd go online. It's probably a lot easier than calling and waiting on hold. Now, you can defer. You can defer your CPP, push it off till age 70, or you could take it early. Now, every year that you defer, you're adding 0.6% per month, so roughly 7% in total. And every year that you're taking it early, you're reducing it by 0.54%, roughly 32% if you take it at age 60. So you're getting 32% less if you take it at age 60, and you're getting 42% more if you take it at age 70. The key always when it comes to your CPP and taking it early is your personal situation, which takes us to our third question. When should you take your CPP? All right, so you can receive it as early as age 60. We've talked about that. We've covered that. Most Canadians will take it early. There's a penalty for taking it early. We talked about that. A lot of financial planners will tell you to take it as soon as possible. Now, I'm not going to say that. You've probably seen some of our other videos. The key really is your personal cash flow. How is your cash flow at age 60? If you are still working, remember that if you're still working and you elect to take your CPP, that is taxable income. So if you're working, let's say you're making 50 or 100 grand and you take CPP and it gets added to your income, that means you're being taxed on that at a much higher tax rate than you would be. So if you're taxed at a 40% tax rate, your $1,000 is now only, $600. So you've given a big chunk of your CPP away to tax because you are already earning income. If you have the cash flow and you don't need the income, and there's no reason to expect that you'd have a health concern or a reason for reduced expected life expectancy, I would consider deferring if I were you. Now, it's a tough recommendation to make, so I don't know your personal situation. Don't take this as financial planning advice. We do this for clients, and we go through a rigorous, detailed analysis of your personal situation. That's not what I'm doing here. I'm telling you things to consider. If you're working, you have a high income, you don't need the cash flow, and you're not expected to have a reduced life expectancy, you should consider deferring. It's going to add a much more cash flow, because consider this. At some point, you're going to retire. At some point, you're going to stop working. When you stop working, the only income you're going to get is likely your CPP, your OAS, and maybe some other rental properties or something like that. So your income is expected to be a lot lower. Since it's a lot lower, you're getting the double whammy. You're getting more after-tax income from that CPP, and because you deferred it, you're getting an extra, 6 or 7% every year that you're deferring. All right. So it's a double whammy. And I would strongly consider, if you're in that position, to consider taking it later. Now, if you need the cash flow, straight up, if you need it to put food on the table or to live the life you want to live, take the CPP, end the discussion right there, and just take it. Next question. What can affect my CPP? All right, so we talked about low income years, and we talked about how they're automatically deducted from the benefit calculation. And we also talked about further lower income earnings will also shrink your CPP check. So that includes stuff as, easing into retirement, right? So let's say you start easing into retirement at age 55. Well, if you don't take your CPP till age 65, you're going to have 10 years there of reduced earnings, which are going to affect your CPP. Now, in the grand scheme of things, we're talking about a few $100s per month. So this certainly is not a reason to dramatically alter your retirement plan, but it's something to consider. You can continue to work even when you take your CPP. We talked about it. You are going to have to continue to pay into the plan even if you're taking your CPP. So you do get a supplement to your pension, but it's something to consider, right? So that's going to affect your CPP. You can also apply if you've had years where you were raising a family, or you had a disability, you could apply to get those years excluded. I would definitely work with your financial planning specialist, someone like me and my team here. We have a wealth and estate planning specialist to figure out how the CPP is affected. Fifth question, when should I defer? All right, so this is a similar question to the past one, but it's a little more pointed. The deferring from 65 to 70, I would suggest to you, you need to have a pretty good idea that you're going to live at least 14 years after the deferral, because that's your break-even point. So if you're deferring to 70, you need to live till 84 for you to be ahead using basic financial planning assumptions. So that's a pretty significant leap. But if you don't need the cash flow, you will be ahead. And not only that, but every year you live past 84, you're miles ahead, because you're now getting 42% extra income every single year. That's a big, big number. So if you think your health is strong, if you don't need the cash flow, if you're in a top tax bracket already at age 65, let's say you have a ton of income through rental properties, businesses that you own, maybe you have a corporate structure that's paying you dividends every year. Maybe you just have royalties that are coming in from some investments you've made, or just a really large investment portfolio and large RIFs that you're drawing down on. If that's the case and you already are in a top tax bracket, you should consider deferring all the way up to age 70. And the sixth thing that you need to know about your CPP, 3 words: plan, plan, plan. It's incredibly easy to forget that the CPP is coming and all of a sudden we're 65 or we're 60 and we don't know what to do and we're scrambling and you fall into making the bad decisions. I can't tell you how many times I've seen individuals take CPP early, extremely early, and that was not in their best interest because they didn't plan. So I would strongly suggest, if you work with an investment professional like myself, reach out to that person. If you don't think you're getting that proper advice from your investment professional, reach out to us. This is what we do. This is all we do. We have an entire team dedicated to wealth and estate planning, and we take a look at that CPP decision. It is a core component to your wealth. It's a core component to your retirement. It's something that needs to be taken seriously. Reach out to us, www.speaktorob.com. We'd love to book a no obligation consultation with you to chat about this or anything else that's on your mind in retirement. Award-winning portfolio management team, also phenomenal when it comes to retirement planning and the CPP decision. So thank you for tuning in. Take a sec to subscribe, like, share, and follow. Subscribe. Press the button and just subscribe to the video. Come on, you made it this far. Thanks for tuning in. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. Thank you so much for tuning in. I will see you real soon in our next video.